So much. One of the most buzzed about real estate deals of the year, certainly Wells Fargo, teaming up with the Blackstone Group just 2 weeks ago in a $23 billion acquisition of GE Capital's real estate assets. Here now, Blackstone Chairman and CEO Steve Schwarzman and how he characterized it at the Milken Conference this week.
This is the second largest real estate deal in history, anywhere in the world. We brought in Wells Fargo, who we invest with a lot. They're limited partners of ours and have been since our first fund in 1993. And they took the senior loans. We took all the mezzanine as well as the equity.
I want to bring in Wells Fargo Chairman, President, CEO right now, John Stumpf, to weigh in on this. Jerry Baker from the Wall Street Journal also with us. John, good to see you.
Nice to see you.
Thank you so much for joining us. Why was this deal so attractive to you, the GE Capital assets? These
loans are very much like the loans we make, and we're the largest commercial real estate lender in the country, and this is kind of a once-in-a-lifetime opportunity. Rarely does a big player in the market exit the market and give us an opportunity. So, as Steve had mentioned, they're great partners of ours. They took the mezzanine and the things that didn't fit for our bank portfolio, but we financed some of those and we put the rest in our portfolio.
Let me just follow up on that, because this was the first tranche of the GE sale. Right. We know that there are more assets out there. Are you poised to be an acquirer as those other assets come up for sale?
You know, the way we like to think about it is we loved what we did, and if that's all we do, that's terrific. If we do some other things, that's also going to be terrific. So, you know, who knows on these things. But in this case, 1 + 1 + 1 made 5. I mean, this was a great deal for GE, and you saw how their stock
went up 15%.
Yeah, it was a great deal for Steve and the Blackstone team, and a great deal for us. So we love this.
Jerry.
I just want to, could we talk generally about the real estate market? It has been, it's been coming back now significantly over the last 5 years. There are some concerns that in some areas, maybe whether it's commercial or residential, that maybe prices have got a little ahead of themselves. How broadly do you see it?
Well, I think that for the stuff that we do, and we've always been very selective in how we make our loans, our portfolio's never been better, and we're seeing growth. I mean, if you fly around the country, almost any place you land, you see cranes. It's like a crane convention going on, and that surely is true in the Bay Area. It's true here when I came in yesterday in Manhattan. So things get frosty from time to time, or frothy. Interest rates have probably a little bit to do with that, but I wouldn't say overbuilt. Surely not on the residential side. I mean, new home starts or $1 million or so, and that's well under. On the commercial side, it tends to be more about, what happens with infrastructure. The public side tends to happen later. The private side tends to happen first.
Have you seen interest rates again took another downturn, unexpectedly took another downturn in the first quarter of this year? Did you see a big increase in either refinancing or in new originations?
On the residential side, absolutely, yes. And so we are going into our second quarter with a $44 billion pipeline, and that is the second highest pipeline we've seen now in 2 years. So, and there was a refinance part of that. Also, FHA has reduced their guarantee fee, so that puts more of those in play. But it's much more of a purchase money business today, and we'll see again, we're starting the selling season now, or the buying season, so let's see what happens.
Now, let me stay on interest rates here, because the story of your company, certainly as well as the industry, has been the compression of net interest margin as a result of where interest rates are right now. Right. How do you grow the bank and see sustainable growth in the next couple of years as we see this pressure coming from interest rates, as well as broad economy? Look, the GDP yesterday told the story, up 0.2%. We're in a sort of 2 steps forward, 1 step back economy.
Yeah, so let's just, for your listeners, describe the margin. We make about half of our money on the margin. You lend money out at 3% or 4%, taking it at 1%, and you make a 3% spread. Our margin used to be 5.5%. Today, we finished the first quarter under 3% for the first time in my 33 years with the company. We make the other half in fees for services. But you're right, in that spread business, as rates have come down, assets have refinanced, and liabilities are next to zero, so there's no place to go. We're still growing net interest income because the balance sheet is growing. We're growing loans and we're growing deposits. So for those companies that are only in the spread business, that don't have half of their revenues coming from fees for services, it's really difficult. But we always say that, yes, we look at the margin, but we focus on net interest income. And when you're growing deposits by $100 billion a year and loans by $50 billion, or whatever the number is, good things happen. Someday this will turn around, but I'm probably of the position, I am of the position that you're going to see long rates rise a lot slower than a lot of people think they will. The rest of the world has lower rates. They're starting their QE programs, which have a way of damping rates.
Some in negative.
Some in negative territory.
Yeah,
exactly. And so as the Fed starts to lift off on the short end of the curve, which I think they will probably in September, I think it'll be almost ceremonial that we start. I think you might see a flattening of the yield curve. I don't think you're going to see long rates move up all that much, because every time they do, money comes in from everywhere to buy those term assets, and it brings rates down.
It's been a revolution in banking in the last 10 years. It wouldn't be over-dramatizing it to call it that. You had the financial crisis. You had this extraordinary regulatory response, which is, some people have said has left the banking system essentially as kind of like a regulated utility. Different banks.
I disagree with that.
Okay, well, I'd like to hear that. But different banks have gone their own different ways as a result.
Yeah.
Goldman have very much stuck to their sort of traditional books and had a very good first quarter of this year. By the way, JP Morgan have to some extent, although with acquisitions as a result of the crisis, they've got into other things too. Morgan Stanley have gone very much more into the broking and asset management. Wells Fargo, you're one of the biggest of the lot. Where do you see now the growth in the next 5 to 10 years for you?
First of all, we are in the real economy. 97% of our revenues are here in the United States. We love our international business, but it's basically to support our U.S. customers.
With a huge deposit base.
And with a huge deposit base. We love that. So we love taking deposits, making small business loans, auto loans, car loans, commercial real estate, energy, ag. And as America grows, we grow with them. But the other thing, we still have 7,000 banks. And there is consolidation going on. Even if it's not one buying the other, customers are moving, and they're making their own choices. We're growing faster today than I've seen in my entire history in the industry, because millennials, in particular, love the convenience of what we have to offer. They love the distribution, the omni-channel. We grew net new primary checking accounts, which I really use as a proxy for a customer. It's where you work, where you get paid, and they put it in the bank, and that's where they operate out of, by 5.7% last year. That's unheard of. We grew $100 billion in deposits. That's at 9 basis points. That's unheard of.
And that kind of loyalty brings me to the stickiness of your business.
Absolutely.
And what you want to do with the brokerage business, what you want to do with the capital markets exposed business, because that's an opportunity for you to get some of those customers that are your deposit customers and bring them over to the other side of the business.
Absolutely. In fact, this morning, before here, even though it's an important part of my day, it wasn't the most important. I went and met with a bunch of our team members this morning who are here in the city. These are our top 3% of our wealth managers. We had a recognition event, and we have about $1.6 trillion of assets under management. We have another $1.6 trillion that are with our customers who call us their bank away someplace else.
Right.
So that's the magic part of doing more with existing customers. Your best new opportunity is something with your existing customers.
Would you say that wealth management, asset management, that is really one of the areas that you're really looking at?
There's nothing even close as number 2. And now we'd love to be bigger in the card business. We'd love to have more asset management and so forth. Wealth there's nothing more. There's nothing that's, because just think of, I think there's going to be like $41 trillion of wealth transferred from one generation to another one in the next 20 years.
But it brings up a really important balance that you obviously think about a lot, because you're a globally, systemically important financial institution, right? A Gsib. And at the same time, you don't want to get to the extent that you are going to fall under getting in the penalty box like a JPM, like a Citi, where at the same time you want to grow this business.
We run a very simple business. We talk with customers, they do business with us. We handle them through their life cycle. And I don't want to diminish the fact of our size and the things. We do some very sophisticated things with some long-term customers. But we are in the real economy banking business. We do things for customers. We do it largely here. We're very transparent. Most of our assets are within the bank. So
should you be deemed a Gsib?
Well, I don't think so, but I mean,
that's what I'm saying.
To be honest, from a size perspective, I can understand
because of the capital markets businesses.
Because we're large.
Size.
If you think about the size of the company, but from a
and you're taking in deposits, so you have a huge number of deposits. There is an immediately significant.
It's a huge responsibility. After all, I mean, customers, we're in the trust business. They trust us to take care of things. But from an interconnected, from a global, from a we're not.
It's night and day.
We have much more. Our DNA is much more common with a community bank than it is with a money center bank.
Yeah.
That's just not where our DNA
When
is.
I spoke with one of your investors, they said, I want to call him the largest regional bank in the world. We're going to talk more about this.
That's a compliment.
Yeah, exactly. It is a compliment. I want to talk more about this, John, so stay with us. Jerry Baker, great to see you today.
Thank you very much.
Thank you so much for joining us. Jerry Baker, the editor-in-chief of the Wall Street Journal. We'll have more.